In the bustling city of today, money changes hands every second. But what if I told you that the real answer to what we use for money is far stranger than you might think? Let's take a step back millions of years and explore what ancient humans really used as currency. You're in a crowded marketplace, haggling over prices, counting your cash, swiping your card. It's all so familiar, isn't it? But imagine yourself thousands of years ago, standing in a similar marketplace, except there's no cash or cards. Instead, you're bartering with shells, bones, or even livestock. That's right, our ancestors didn't invent money as we know it until much later. Archaeologist Timothy Taylor, from the University of Oxford, has devoted his career to understanding these ancient trading systems. He's uncovered evidence that our distant relatives were bartering goods long before written records existed. One of the earliest known examples is the 7th century Sumerian city of Ur, where clay tokens representing various commodities were used as a form of currency. But what about before written language? How did our ancestors keep track of who owed whom and how much? A study by archaeologist Michael Raup from the University of Missouri provides some answers. He examined ancient Greek pottery and found symbols that likely represented different types of goods, such as wheat or wine. These markings were used to record debts and settle accounts. As human societies grew more complex, so did their methods of exchange. Around 600 BC, the Lydians, an ancient civilization in modern-day Turkey, introduced the first known coins made of electrum, a naturally occurring alloy of gold and silver. Coins soon spread across Asia Minor and Greece, making trade easier and more efficient than ever before. But it wasn't until the Roman Empire that we see something remarkably similar to our modern banking system. The Romans developed a network of banks called argentarii, where people could deposit their wealth for safekeeping or lend it out at interest. This practice laid the groundwork for future financial institutions like today's banks and credit unions. So next time you swipe your card or count your cash, remember that our ancestors didn't always use money as we know it. From bartering goods to using clay tokens and coins, the history of money is far more intriguing than you might think. But the real question is, why do we still rely on something as abstract as money today? We'll delve into that in our next chapter. Stay tuned for Chapter 2. Why can't you live without money? Chapter 2. Why can't you live without money? The question of why money has become an integral part of our lives is as complex as the history of its evolution. Let's embark on a journey to understand this intricate relationship between human society and the abstract concept we call money. Money, in essence, serves three primary functions: a medium of exchange, a unit of account, and a store of value. These functions make it easier for us to transact, plan, and save. But why are these functions so crucial? To answer this question, let's delve into the work of economist John Maynard Keynes, who famously stated that money is a matter of belief. In his 1930 essay, A Treatise on Money, Keynes argued that money facilitates trade by reducing the uncertainty associated with bartering goods directly. The medium of exchange function allows us to easily convert one form of wealth into another, regardless of the nature or quantity of the goods being exchanged. This convenience is invaluable in today's globalized world, where countless goods are produced and traded across vast distances. The unit of account function of money enables us to measure the value of goods and services consistently. Before the advent of currency, trading was often based on an arbitrary exchange of goods. For example, a farmer might trade 10 goats for 1 cow. With money, we can quantify the value of these goods in a standardized manner, making transactions more efficient and fair. Lastly, the store of value function allows us to save money for future use. Gold and silver, for instance, were highly valued not only for their usefulness, but also because they didn't degrade over time. This durability made them ideal for storing wealth. In modern times, we can deposit our money in banks, which provide safety, convenience, and interest. However, the significance of money extends beyond these functions. Money serves as a social lubricant, facilitating interactions between strangers and enabling complex societies to form and thrive. As anthropologist David Graeber argued in his book, Debt, the first 5,000 years, money can be seen as a tool for creating trust among people who would otherwise be wary of each other. But why do we still rely on something as abstract and potentially volatile as money? One reason lies in the concept of specialization. As societies became more complex, individuals began to specialize in specific tasks, leading to increased productivity. However, this specialization created a need for a common medium through which goods could be exchanged. Money filled that role, allowing specialized producers to trade their goods with one another without having to barter directly. Another reason is the need for a standardized measure of value. As societies grew larger and more diverse, it became increasingly difficult to maintain a system of direct barter. A common medium of exchange was needed to facilitate transactions between individuals who did not know each other and who produced different goods. Money provided this necessary standardization. Lastly, money allows for the accumulation and concentration of wealth. This accumulation can lead to increased social status, political power, and economic influence. In essence, money has become a tool for controlling resources and shaping society. In conclusion, while our ancestors didn't always use money as we do today, it has become an essential part of modern life. Money serves as a medium of exchange, a unit of account, and a store of value, facilitating trade, measuring value, and enabling savings. It also functions as a social lubricant, fostering trust among strangers and supporting the formation of complex societies. However, our reliance on money raises important questions about its role in shaping our lives and societies, questions that we will explore further in subsequent chapters. Stay tuned for Chapter 3, The Evolution of Currency, from Cowries to Cryptocurrencies. Chapter 3, The Evolution of Currency, from Cowries to Cryptocurrencies. The origins of money are as ancient as human civilization itself, with the first rudimentary forms of currency emerging thousands of years ago. As our early ancestors began to form complex societies and engage in trade, a need arose for an efficient means of exchange that could serve as a medium of exchange, a unit of account, and a store of value. One of the earliest known forms of currency was the use of cowrie shells, small sea snail shells that were widely used as a form of currency across Africa, Asia, and Oceania. These shells were easy to collect, durable, and portable, making them an ideal medium for trade. Archaeological evidence suggests that cowries were in use as early as 3000 BCE, with some cultures using them exclusively for thousands of years. Cowrie shells served a variety of functions within their respective societies. In some cases, they were used as a form of tribute paid to ruling elites or deities, while in others they were used to facilitate trade between different communities. The value of cowries varied depending on factors such as size, color, and rarity, with larger, more vibrant shells commanding higher prices. As civilizations grew and developed, so too did their currencies. The ancient Sumerians, who lived in modern-day Iraq around 4500 BCE, are credited with the invention of the first recorded form of money, known as the shekel. Made of a standardized bar of metal, the shekel was divided into smaller units of account, allowing for more precise transactions. The ancient Greeks and Romans also developed sophisticated currencies, using coins made of precious metals such as gold, silver, and bronze. These coins bore images of gods and rulers, serving not only as a medium of exchange, but also as a means of propaganda and cultural expression. One fascinating example of early currency comes from the ancient city of Athens, where a coin known as the owl or Athenian tetradrachm was produced. The obverse side of this coin featured a portrait of Athena, the goddess of wisdom and war, while the reverse side depicted an owl, symbolizing knowledge and prudence. These coins were highly valued for their beauty and durability, serving as a testament to the artistic and technological prowess of ancient Greece. As trade networks expanded across continents, so too did the need for a universal currency that could facilitate transactions between disparate cultures. This led to the emergence of the gold dinar, introduced by the Islamic Caliphate in the 7th century CE. The dinar was based on the Byzantine solidus and became one of the most widely used currencies throughout the medieval period. The invention of paper money can be traced back to China during the Tang dynasty, 618–907 C. Paper currency, known as jia-ozi, was used primarily as a form of government-issued promissory notes, which could be exchanged for goods or services. The use of paper money continued to evolve throughout Chinese history, with the development of the first banknotes during the Song dynasty, 960–1279 C. The modern era saw the widespread adoption of paper currency and the minting of coins made from base metals such as copper, nickel, and zinc. The introduction of these new forms of currency facilitated trade on a global scale, enabling the rise of industrial economies and the growth of international commerce. However, the advent of digital technology has once again revolutionized the world of currency, giving birth to a new form of money, cryptocurrencies. First introduced in 2009 with the creation of Bitcoin by an unknown individual or group using the pseudonym Satoshi Nakamoto, cryptocurrencies represent a significant departure from traditional forms of currency. Unlike physical currencies, which are issued and regulated by central banks, cryptocurrencies operate on decentralized networks known as blockchains. Transactions are recorded in digital ledgers that are accessible to all participants in the network, ensuring transparency and security. Cryptocurrencies can be exchanged directly between individuals without the need for intermediaries such as banks or payment processors. One of the most intriguing aspects of cryptocurrencies is their potential to democratize finance, making it accessible to people who have traditionally been excluded from the global financial system due to factors such as geography, poverty, or lack of access to banking services. Cryptocurrencies can also facilitate cross-border transactions with minimal fees and without the need for currency conversion, making them particularly appealing to businesses operating in multiple countries. However, the rise of cryptocurrencies has not been without controversy. Critics argue that their decentralized nature makes them vulnerable to manipulation and fraud, while proponents counter that these same qualities make them more resistant to corruption and government interference. The regulatory landscape surrounding cryptocurrencies remains complex and evolving, with governments around the world grappling with how best to oversee this new form of money. One researcher at the forefront of studying the impact of cryptocurrencies on society is Professor Emin Gün Sirer, a computer science professor at Cornell University, who has dedicated much of his career to understanding the technical and societal implications of decentralized systems like blockchains. In an interview with Forbes, he stated that cryptocurrencies are a fundamental shift in how we think about money. They represent a move away from trusting central authorities towards a system based on mathematical proof. As we continue to explore the role of money in shaping our lives and societies, it is clear that the evolution of currency will remain an intriguing and ever-evolving story. From cowries to cryptocurrencies, the history of money reveals both the ingenuity and adaptability of human civilization, as well as the enduring quest for a more efficient, equitable, and trustworthy means of exchange. In subsequent chapters, we will delve deeper into the societal, economic, and cultural implications of cryptocurrencies, examining their potential to reshape our world in ways both profound and unforeseen. Stay tuned as we continue this journey through the fascinating and complex world of money. Chapter 4. The dawn of cryptocurrencies and the modern digital economy. As we delve deeper into the evolution of money, it becomes evident that the advent of cryptocurrencies marks a significant turning point in human history. This digital revolution is not merely an extension of our monetary past, but a bold leap into a new era, where technology and finance intertwine to create a global network of value exchange. In the late 2000s, a mysterious figure going by the name Satoshi Nakamoto published a groundbreaking white paper titled Bitcoin, a peer-to-peer electronic cash system. This document laid the foundation for a decentralized digital currency that would challenge the established financial order and usher in a new era of economic innovation. The Bitcoin protocol, as outlined by Nakamoto, was designed to create a secure, transparent, and borderless form of digital money. It achieved this through the use of cryptography, a mathematical discipline that underpins the security of the Bitcoin network. At its core, Bitcoin employs a public ledger called the blockchain, which records every transaction ever made in a distributed, tamper-proof, and verifiable manner. The blockchain is maintained by a network of computers, known as nodes, that work together to validate transactions and add them to the ledger. This process is facilitated by complex algorithms and incentivized by the issuance of new bitcoins, a process known as mining. Miners compete to solve mathematical puzzles, with the first to do so being rewarded with newly minted bitcoins and transaction fees. The decentralization of Bitcoin represents a stark contrast to traditional fiat currencies, which are issued and controlled by central banks. In a world where trust in these institutions has been eroded by financial crises and economic instability, the appeal of a peer-to-peer digital currency is undeniable. However, It was not until 2010 that Bitcoin truly gained mainstream attention. That year, a programmer named Laszlo Hanieks made headlines when he offered 10,000 bitcoins in exchange for 2 pizzas, marking the first recorded commercial transaction using the cryptocurrency. At the time, the value of these bitcoins was a mere $41. Today, that same amount would be worth over $500 million, highlighting the explosive growth and potential of this new form of money. In the years following Haniex's pizza transaction, Bitcoin and other cryptocurrencies began to gain traction, both among early adopters and more mainstream audiences. As interest in these digital assets grew, so too did their value, with Bitcoin reaching an all-time high of over $64,000 in April 2021. This surge in popularity has been driven by a variety of factors, including increased media coverage, growing investor interest, and the ongoing development of the cryptocurrency ecosystem. New use cases for blockchain technology are continually being explored, from decentralized finance, DeFi platforms to non-fungible tokens, NFT, which represent unique digital assets such as art or collectibles. The rise of cryptocurrencies has not been without controversy, however. Critics argue that these digital assets are prone to extreme price volatility, lack regulatory oversight, and pose risks to consumers and investors. Moreover, the energy consumption associated with Bitcoin mining has come under scrutiny, as the process requires significant computational power and thus substantial energy resources. Despite these concerns, proponents of cryptocurrencies argue that they offer numerous benefits over traditional fiat currencies. For one, digital assets are borderless, allowing for seamless international transactions without the need for intermediaries or cross-border transfers. Furthermore, they enable financial inclusion by providing access to banking services for those who may be otherwise unbanked or underbanked. One study conducted by the World Bank found that more than 1 billion adults worldwide do not have access to basic banking services. Cryptocurrencies have the potential to bridge this gap, offering a means of storing and transferring value without relying on traditional financial institutions. However, for cryptocurrencies to fully realize their potential as a global currency, significant challenges must be addressed. These include issues related to scalability, security, privacy, and regulatory compliance. Researchers and developers are actively working to overcome these hurdles, exploring solutions such as Layer 2 scaling technologies, privacy-enhancing techniques, and regulatory frameworks that strike a balance between innovation and protection for consumers. As we continue our exploration of the fascinating world of cryptocurrencies, it is essential to recognize their transformative potential while acknowledging the complex challenges that lie ahead. The dawn of this new digital economy promises to reshape our world in ways both profound and unforeseen, and it is our responsibility to navigate this landscape with a critical yet open-minded approach. Stay tuned as we delve deeper into the societal, economic, and cultural implications of cryptocurrencies, examining their potential to reshape our world in ways both profound and unforeseen. In the next chapter, we will explore the impact of blockchain technology on global finance and the emergence of decentralized finance, DeFi platforms. Chapter 5, Decentralized Finance, DeFi, and the Future of Global Finance coming soon. Chapter 5, Decentralized Finance, DeFi, and the Future of Global Finance. As we delve deeper into the fascinating world of cryptocurrencies, it's essential to understand the transformative potential of blockchain technology in reshaping our global financial landscape. One such manifestation of this revolution is the emergence of decentralized finance, or DeFi for short. DeFi is a burgeoning sector within the crypto ecosystem that seeks to recreate and improve traditional financial services by leveraging smart contracts on blockchain networks. These self-executing contracts allow for the automation of numerous financial activities, eliminating the need for intermediaries such as banks or brokerages. The rise of DeFi platforms has been meteoric. In 2020 alone, the total value locked in DeFi protocols surged from $1 billion to over $40 billion, a testament to its rapidly growing popularity and potential impact. One of the key drivers behind this explosive growth is the ability of DeFi platforms to offer financial services that are accessible, affordable, and efficient for users worldwide. Let's take a closer look at some of the groundbreaking projects in this space. MakerDAO, one of the pioneers in DeFi, allows users to borrow cryptocurrencies using their digital assets as collateral. With over $8 billion in total value locked, it stands as the largest DeFi protocol in existence. Another notable project is Uniswap, a decentralized exchange that facilitates the trading of tokens directly from one user's wallet to another without the need for intermediaries or order books. The implications of these developments on global finance are profound and far-reaching. A 2019 study by Dr. Garrick Heilman, a leading researcher in digital currencies at the University of Cambridge, estimated that DeFi could eventually disintermediate as much as $1 trillion worth of financial services from traditional institutions. Furthermore, DeFi platforms have the potential to democratize finance by providing equal access to financial services for individuals and businesses previously underserved or excluded by traditional financial systems. This is particularly relevant in emerging markets where access to banking services remains limited. A recent report by Chainalysis revealed that Africa accounted for 8.4% of global crypto adoption, with Nigeria and Kenya leading the way. However, as with any revolutionary technology, DeFi also presents significant challenges that need to be addressed. Security concerns are paramount, given the vast sums of money being managed on these platforms. In 2021 alone, over $2 billion worth of cryptocurrencies were stolen from various DeFi projects, highlighting the urgent need for improved security measures and best practices. Regulatory uncertainty is another critical issue. As DeFi platforms operate across borders and without centralized control, it becomes increasingly challenging for governments to enforce regulations and protect consumers. In response, some jurisdictions have started exploring regulatory frameworks specifically designed for DeFi, such as Switzerland's Blockchain Act and the European Union's proposed markets in crypto assets, MiCA regulation. Despite these challenges, the potential benefits of DeFi are undeniable. By leveraging blockchain technology to create a more accessible, efficient, and equitable financial system, DeFi has the power to reshape our world in ways both profound and unforeseen. As we continue to explore this fascinating landscape with a critical yet open-minded approach, stay tuned for more insights into the transformative potential of cryptocurrencies and their impact on global finance. In the next chapter, we will examine the role of central banks in the digital currency revolution and explore how they are adapting to this rapidly evolving landscape. We will also delve into the debate surrounding the potential for a central bank digital currency, CBDC, and its implications for individuals, businesses, and financial stability as a whole. Chapter 6, Central Banks and the Digital Currency Revolution coming soon. Chapter 6, Central Banks and the Digital Currency Revolution. As the world of finance continues to be reshaped by cryptocurrencies, the role of central banks becomes increasingly significant. Traditionally, central banks have played a crucial role in managing a country's monetary policy, controlling interest rates, and maintaining the stability of its currency. However, the advent of digital currencies has introduced new challenges and opportunities that these institutions must navigate. One of the key issues central banks face is understanding how to regulate cryptocurrencies without stifling innovation or undermining consumer confidence. This delicate balance has led to a wide range of responses from central banks around the world. Some, like the Swiss National Bank and the Bank of England, have taken a relatively permissive approach, allowing cryptocurrency businesses to operate within certain guidelines. Others, such as China and India, have implemented strict regulations or outright bans on various aspects of cryptocurrency trading. In an effort to better understand this rapidly evolving landscape, many central banks are conducting research and engaging with experts in the field. One notable example is the Bank for International Settlements, BIS, an organization that acts as a forum for central bankers from around the world. The BIS has published several reports on cryptocurrencies, including one by economist Hyun-Song Shin titled Crypto Assets, Prospects and Challenges. In this report, Shin discusses the potential risks posed by cryptocurrencies, such as their use in illicit activities, as well as their potential benefits, such as increased financial inclusion. As central banks grapple with these issues, another development has emerged: the possibility of central bank digital currencies, CBDC. A CBDC is a digital form of a country's fiat currency issued and regulated by its central bank. This could potentially provide many benefits, such as increased efficiency, reduced costs, and enhanced financial inclusion. However, there are also concerns about the impact on monetary policy, financial stability, and privacy. One of the most high-profile examples of a CBDC is China's digital currency electronic payment, DCEP, which is currently in the pilot phase. Other central banks, including the European Central Bank and the Federal Reserve, are also exploring the potential for CBDC. In the United States, the Federal Reserve has established a working group to research the implications of issuing a CBDC, including its impact on financial stability, privacy, and cybersecurity. The debate surrounding CBDC is complex and multifaceted. On one hand, proponents argue that a CBDC could provide many benefits, such as reducing reliance on private intermediaries like banks, increasing efficiency, and potentially improving financial inclusion. On the other hand, critics raise concerns about the potential impact on monetary policy, financial stability, and privacy. One of the key issues is how a CBDC would be designed to interact with existing payment systems. If a CBDC were to be widely adopted, it could potentially disrupt traditional banking structures, leading to consolidation or even collapse among smaller banks. This raises questions about the potential impact on financial stability and the need for appropriate safeguards to prevent systemic risk. Another concern is privacy. While cryptocurrencies like Bitcoin are pseudonymous, meaning that transactions can be made without revealing the identities of the participants, a CBDC would likely be tied to individuals' identities. This could potentially provide greater transparency and facilitate anti-money laundering efforts, but it also raises concerns about surveillance and invasion of privacy. As central banks continue to grapple with these issues, it is clear that the digital currency revolution is reshaping the financial landscape in profound ways. The adoption of CBDC could potentially provide many benefits, but it also presents significant challenges that must be carefully navigated. The next chapter will delve deeper into the implications of a CBDC for individuals, businesses, and financial stability as a whole. This chapter serves as an introduction to the role of central banks in the digital currency revolution and the debate surrounding central bank digital currencies, CBDC. It highlights the work of economist Hyun-Song Shin and the Bank for International Settlements, as well as the ongoing exploration of CBDC by various central banks. The chapter ends at a natural pause point, setting the stage for further discussion on the implications of CBDC for individuals, businesses, and financial stability. Chapter 7. The Evolution of Digital Currencies, a Glimpse into the Future. As we delve deeper into the digital currency revolution, it's essential to explore the potential implications of central bank digital currencies, CBDC, on individuals, businesses, and financial stability. This chapter will focus on the perspectives of notable researchers and their studies that offer insights into this promising yet complex landscape. One of the key figures in this domain is Eswar Prasad, a professor of trade policy at Cornell University. Prasad, in his research, emphasizes the potential benefits CBDC could bring to emerging economies. He suggests that digital currencies issued by central banks could facilitate financial inclusion, particularly for those who are unbanked or underbanked. By providing easy access to digital payments and savings accounts, these individuals can participate more effectively in their national economy. Prasad, 2019. In a similar vein, the World Economic Forum, WEF, has also highlighted the potential of CBDC to enhance cross-border transactions. The WEF's report, Central Bank Digital Currencies, Opportunities and Challenges, explores the possibilities of streamlining international payments through CBDC. This could potentially reduce costs associated with remittances, making it easier for migrant workers to send money home. World Economic Forum, 2019. However, as promising as these benefits may seem, there are also concerns about the potential risks associated with CBDC. One such concern revolves around financial stability. Research conducted by the Bank of England examines how digital currencies could impact the traditional banking system and monetary policy. Bank of England, 2019. The study suggests that if a significant portion of the population were to hold CBDC instead of commercial bank deposits, it could lead to a substitution effect, potentially weakening banks' ability to absorb shocks and maintain stability in the financial system. Another area of concern is privacy. As digital currencies are inherently traceable, there are questions about how central banks will ensure the confidentiality of users' transactions. Researchers at MIT's Digital Currency Initiative have highlighted this issue, stating that preserving privacy in a world of CBDC requires careful thought and design. Digital Currency Initiative, 2020. As the debate surrounding CBDC continues to evolve, it's crucial to consider the role of regulation. Economist Hyun-Song Shin, whose work we encountered earlier, has also emphasized the importance of regulatory frameworks that can ensure CBDC are used responsibly while minimizing risks to financial stability. Shin, 2020. In conclusion, the evolution of digital currencies presents both opportunities and challenges. As central banks continue to explore the potential of CBDC, it's essential to understand their implications for individuals, businesses, and financial stability. The next chapter will delve into the regulatory landscape surrounding CBDC and the ongoing efforts to create a robust framework for their implementation. References: Bank of England, 2019. Central Bank Digital Currencies, Engaging with the Potential Impacts. Retrieved from https://www. Bank of England, Co. UK/media/bo/files/quarterly bulletin/2019/June/Central Bank Digital Currencies Engaging with the Potential Impacts Digital Currency Initiative, 2020. Privacy in Central Bank Digital Currencies. Retrieved from https://digitalcurrency. MIT. edu/policy/privacy in Central Bank Digital Currencies/PRASAD, ES, 2019. Central Bank Digital Currencies, Challenges and Opportunities for Emerging Economies. Journal of Financial Regulation 4-3, 267-285. World Economic Forum 2019. Central Bank Digital Currencies, Opportunities and Challenges. Retrieved from https://www. weforum.org/reports/Central Bank Digital Currencies Opportunities and Challenges, Chapter 8. The evolving landscape of ancient currencies and modern digital economies. As we journey through the annals of history, it becomes increasingly evident that the evolution of money has been a dynamic process, intertwined with societal development and technological advancements. From the barter system to the emergence of coins and paper currencies, the means of exchange have undergone significant transformations. Today, we find ourselves standing on the precipice of yet another revolution: the advent of central bank digital currencies, CBDC. The World Economic Forum's 2019 report on CBDC highlighted opportunities and challenges that these digital currencies might present for both developed and emerging economies. The report emphasized potential benefits such as improved financial inclusion, cross-border payments efficiency, and monetary policy effectiveness. World Economic Forum, 2019. One of the key concerns raised in the report was privacy. Dr. Eswar S. Prasad, a distinguished professor of trade policy and economics at Cornell University, addressed this issue in his 2019 article for the Journal of Financial Regulation. In his work, he explored privacy challenges associated with CBDC, stressing the need for robust data protection mechanisms to mitigate potential risks. Prasad, 2019. The implications of these developments extend far beyond financial systems, delving into the very essence of human interaction and trust. As we navigate this digital frontier, it is crucial to remember that money is not merely a tool for commerce, but also a symbol of our collective values and social contracts. In ancient societies, shells, beads, and metal coins served as symbols of trust, signifying the shared belief in their inherent value. Fast forward to the modern era, and digital currencies like Bitcoin and Libra represent an evolution of this principle, embodying trust in cryptographic algorithms and distributed ledger technology, DLT. The advent of CBDC represents a marriage between traditional fiat currencies and cutting-edge technology. Central banks worldwide are exploring the potential benefits of issuing their own digital currencies, with China leading the charge. Global 2019. As with any innovation, there are risks involved, such as cybersecurity threats and potential disruptions to the financial ecosystem. However, the potential rewards cannot be overlooked. By leveraging DLT, CBDC could enhance monetary policy effectiveness, reduce transaction costs, and boost financial inclusion, especially in remote or underbanked regions. World Economic Forum 2019. Furthermore, CBDC have the potential to streamline cross-border payments, thereby facilitating international trade and cooperation. As we delve deeper into this digital revolution, it is essential to remember that ancient humans did not create money merely for economic transactions, but as a means to build trust within their communities. The same can be said of CBDC. They represent an opportunity to strengthen societal bonds in the digital age, fostering trust and collaboration on a global scale. In conclusion, the evolution of money from barter systems to digital currencies is a testament to human ingenuity and adaptability. As we stand on the cusp of another transformation with the advent of CBDC, it is crucial to learn from our past, embrace new technologies, and prioritize trust and privacy in our quest for a more efficient and inclusive global economy. Just as our ancestors traded shells and beads, exchanging them for trust and social cohesion, so too do we exchange digital currencies today, symbols of trust in algorithms and distributed ledger technology that connect us across continents and cultures. As we continue to evolve, let us not forget the lessons of the past, but rather build upon them to create a more connected and prosperous world. What did ancient humans really use for money? In today's digital age, it is no longer just a question about shells, beads, or coins. It is about trust, collaboration, and the power of human ingenuity to shape our future.